wait till age 70 to do the fun things you want to do in retirement.
Should people take CPP early, delay it, or start at 65?
If you make the wrong decision on this, it could cost you hundreds of thousands of dollars over your retirement lifetime. One of the most important questions that you need to answer for your retirement income planning is... Hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, along with my co-host, as always, Lindsay Wilson. How's it going, Lindsay?
I'm good, Joe. How are you?
I can't complain. I feel like we're in a pretty good routine to start the year. Getting a little bit ahead on these podcasts, which is nice, so we can make sure we keep the good content coming. And so today we're actually going to revisit a topic we've talked about in different different facets, but today we're going to just dive into some of the most common questions that we get on Canada Pension Plan, or CPP. So these are probably all the questions that you have about CPP, because they're coming from the most common questions that we get from our clients. And rather than talking around it or about a specific piece of CPP, we're just going to kind of dive in and get these questions. So if you're good with it, Lindsay, we can jump right in, I think.
Yeah. So we should start with just what is CPP and why is it important?
Sure. So CPP, or the Canada Pension Plan, is a government-managed retirement program. So it's designed to provide monthly income for retirees who have contributed to the plan during their lifetime, right? So unlike old age security, you don't get it just because you're Canadian. You have to contribute to the plan. And it's really designed to be part of your retirement plan in tandem with other retirement assets you may have built up or other pensions you have from your employer, things like that, right? So it's really, for most Canadians, it is an important piece of the retirement planning, but usually just one piece.
So who's eligible to receive CPP benefits?
Yeah, so as I started to allude to there, to qualify for CPP, you do need to have contributed to the plan during your working years. So if you're working, you're getting your pay stub, your contributions are automatically deducted from your pay. So if you're employed, you're paying your portion of the contributions, and your employer is paying an equal amount of contributions. Or if you're self-employed, you're lucky enough you get to pay both sides of the contributions. But either way, if you're receiving a salary or an hourly wage and anything like that, you are automatically contributing to CPP. And so how much you receive is going to depend on how much you've contributed to the program, which has a lot to do with how many years you worked, what your income was during that time period. So to receive the pension, you need to be at least 60 years old. The standard age to receive the pension or the benefits is 65, or you can also delay to age 70 for an increased monthly benefit.
And how do you apply for CPP?
Yeah, so that's actually an important question, because you have to apply to get your CPP. Unlike OAS, for some people, it will automatically start. So you do need to apply for it, and you can do it through My Service Canada. So you can go on to the Service Canada website, create an account, and you can apply through there. Or if you want, you can do it through like mailing a paper application. So you should apply probably at least 6 months ahead, just to make sure there's no issues. But you can apply as far ahead as 12 months before you want to receive the benefit. There is a benefit, though, to doing it through Service Canada online, because you could get, in as little as 7 days, you could get your answer on what your benefit's going to be and have it all set up and ready to go. Whereas if you do it with the paper application, you could expect to wait around 120 days.
Okay, so quite a difference.
Big time, yeah.
Yeah. So in terms of understanding what amount you get for CPP, how can someone estimate how much CPP they will get?
Sure. So there's a couple of ways to do it. Sorry, Lindsay, I'm losing my voice here.
It's okay.
There's a couple of ways to do it. You can go into your Service Canada account. And again, if you haven't set one up, I would recommend setting one up. So in there, you can find a detailed breakdown of your contributions and an estimate of what you'll receive at different starting ages. So like age 60, 65, and 70. Now, you should know that those estimates that you see there are assuming you continue to work until at least age 65 or up until the date that you're planning on retiring. So, for example, if you're only 50 and you're looking at the age 65 benefit, and then you retire today and don't take the benefit till 65, that's not going to be the benefit you receive. So it's assuming you continue contributing at the same average annual earnings that you have up to that point. Now, if you want a little bit more detail than that, and you want to be able to play with some different projections, PWL Capital has actually created a fantastic CPP calculator. So in the show notes, Lindsay, we'll link to that. So retirementplanningsimplified.ca, you'll find the episode on there. And we'll put a link to the calculator. And it really is great because you can just take from your Service Canada account, you can take the detailed pension contributions that you've made. You can put it into the calculator, and then you can look at retiring at different times, assuming what you're going to earn between now and retirement, things like that, to get a much better picture of exactly what you can expect for your CPP. Now, for 2025, the maximum monthly benefit for CPP at age 65 will be $1,433 per month. But even if you're a high income earner, you should know that most people don't receive the maximum CPP benefit. So the average monthly benefit for new pensioners at 65 last year in 2024 was $808 per month. So again, that's the average. So to receive the maximum, so if you are going to get the maximum, you must have contributed the maximum to the plan for at least 39 years between the ages of 18 and 65, right? So you have to have high income for a sustained period of time. The maximum CPP contribution is based on your earnings up to a yearly limit called the YMPE, or the yearly maximum pensionable earnings. Okay, so this is a limit set by the government. It adjusts annually to account for wage inflation. So to give you a bit of an overview on how this is calculated, we'll kind of walk through it step by step. So the first thing you would do is check your earnings. So CPP contributions apply only to your earnings between the basic exemption amount, so currently that's $3,500, and the YMPE. So for example, if the YMPE is $71,300, which it is for 2025, only your earnings between $3,500 and $71,300 are used to calculate your contributions. So when you go to calculate the contribution rate, the government also sets the percentage for those contributions. So for 2025, the combined employee and employer contribution rate is 11.9%. So if we break that down, the employer and the employee each contribute 5.95% on your earnings between that $3,500 and $71,300. So to do the math on this, you would subtract $3,500, so the basic exemption, from your earnings. You would multiply the remaining amount up to that YMPE, or yearly maximum pensionable earnings. So you would multiply that by 5.95% if you're an employee. If you're self-employed, you pay both the employee and employer portions as mentioned, so that would be 11.9%. Now, I have a bit of an aside here, Lindsay. There is tax deductions and credits related to the contributions, depending on which side of the contribution you are, the employer or the employee. So the total cost to you and to the employer isn't going to be that full amount. And my friend Ervin and I, we went into this in a lot more detail on an earlier episode. So if you want to learn about the tax deductions and credits related to CPP, I would encourage you to check out that episode, which we can link to in the show notes also. So the maximum CPP contribution for 2025, it works out to $4,034 for both the employer and the employee. Now, in the past, that's where contributions used to end, Lindsay, but there's been some changes. So starting last year in 2024, there was an additional contribution element introduced for higher earnings. So this requires contributions on approximately the next $10,000 above and beyond the YMPE. Okay. So the contribution rate for both employers and employees for that roughly next $10,000 is 4% on those earnings, making the additional maximum contribution, if you're a high income earner, to be about $400 for both the employee and the employer. So in the past, maybe if you're a higher income earner, you might have noticed that partway through the year, your CPP contributions stop and your take-home pay increases. So if you see that, it means that you've maxed out your CPP contributions for the year. So I think a lot of people notice that, but they don't really know why that happens. Now, if you're near retirement, you're not going to notice much of a change in the CPP benefits due to this enhancement above the YMPE. But the idea in doing this is that CPP is going to be enhanced for future generations and play a bigger part of their retirement income planning. So that's a long answer to
No, that's
to the question, which is how can you estimate how much CPP you're going to get?
yeah. And what happens to CPP benefits if someone passes away?
Yeah, that's a great question, Lindsay. One that I get all the time. In fact, I got this last night at a workshop I was teaching at Trent University. And the reason I get that question all the time is because people ask about, well, if I delay my CPP and I die, I'm just going to lose it. So we'll talk a little bit about delaying later, but what happens to your CPP benefits if you pass away? Unlike OAS or Old Age Security, CPP does offer survivor benefits to the spouse or common law partner of a deceased contributor, as well as a one-time death benefit. So we won't go into the details on this, but there's also a children's benefit for dependent children up to 18 or 25 if they're still in school. And so these benefits are going to be based on the deceased contribution to CPP. So if the surviving spouse is over 65, they will receive 60% of the deceased pension if the survivor is not receiving CPP. So kind of just like a regular defined benefit pension, often there's a survivor benefit there where if you have the pension, you pass away, your spouse continues on that benefit, but at a reduced amount, like 60 or 67%. So in this case, it's 60% your survivor will get if they're over 65. Now, if they're receiving CPP, so I mentioned if they're not receiving CPP, but if your surviving spouse is receiving CPP, it's important to note that there is a cap on the total combined CPP benefit plus survivor benefit that you can collect, I guess you could say. And it's basically, not exactly, but basically the same as the individual maximum CPP monthly benefit. So that max survivor combined benefit, so your CPP, if you're a surviving spouse, plus the survivor benefit, the max for 2025 is $1,449.
Now, here's a question or a topic that comes up, I think, very often is, should people take CPP early, delay it, or start at 65?
Yeah. So this is one of the most common questions we get, and one of the most important questions that you need to answer for your retirement income planning. That said, we've spoken about this in more detail on several other episodes and videos on YouTube. So in this episode, Lindsay, I'm going to give kind of the high level breakdown. And I'm not going to go into too much detail here, but I'm going to talk about some considerations. So should you take it early? Let's just start here. When would it make sense to take it early? And you can do it as early as 60, as I mentioned. If you do take it early, your payments are going to be reduced by 0.6% of the age 65 benefit for each month you take it before age 65. Okay. Now, whether you should do that or not could make sense if you need the income. So if you don't have other retirement income sources, you're not able to work, whatever the situation is, if you need the money, then you probably need to take the benefit. Okay. So that's kind of number one. And the other main scenario where we would expect or suggest that you take it early is if you know that there's some health concerns, right? So whether there's some health issues you're dealing with, or you have a shortened life expectancy for whatever reason, that would be a good reason to take the reduced amount. Now, take it at 65. So this is the standard age. You'll receive 100% of your calculated benefit. You know, whether you take it at 65 or not, it really just, if we look at, should you take it early, should you take it late? It would be maybe a blending of the reasons on either side of this. There's no real specific reason to take it at age 65. Other than maybe you're retiring at 65 and again, you need the money at that point. So if we talk about delaying, so we can delay up to age 70, the payments increase by 0.7% per month for every month you delay after age 65. And you'll notice that that bonus is larger than the penalty for taking it taking it earlier, which was 0.6%. So if you're healthy, if you have other income sources, this could be a smart move. It could make a lot of sense. In fact, FP Canada has done a lot of research on this. They put out a paper a few years back, which we've talked about on the show. And it talks about, how significant that additional benefit is for delaying on CPP. So again, if you need the money, it's probably not in the cards for you. But what I want to talk about a little bit here is that I think in the past when I've talked about this, or if you watch other videos and there's, the comments coming up about, no, take the money while you're young and healthy. I think people get the idea that what we're trying to say is you should not take the money till 70 and you're just going to live off less money in the short term. And that's not what we're trying to say. We're trying to say that if you have other retirement income sources and maybe some investments like RSPs, is take the additional income you need from those sources until age 70. And then at age 70, you'll have a higher CPP kick in. And so the idea here, again, is not to reduce your lifestyle. It's not saying, wait till age 70 to do the fun things you want to do in retirement. It's just talking about shifting where you're going to take that income from. And so it really depends on your health, your financial situation, your life expectancy, what you should do here. But what I want you to take away from this part of our conversation is do not make the decision to take it early or delay your benefit outside of your actual retirement plan. So don't think of this as like a silo decision. It very much relates to everything else you have going on for your retirement plan, your other income sources, your cash flow needs, all that kind of stuff. And if you make the wrong decision on this, it could cost you tens or even hundreds of thousands of dollars over your retirement lifetime. So it's a big decision that you don't want to take lightly.
And what are the tax considerations for CPP?
Sure. So CPP, like your regular earned income, it is taxable income. So it's going to be added to your other income sources and taxed at your marginal rate. When I say your marginal rate, in Canada, we have a marginal tax rate system. So at different levels of income, so for example, this is not a real tax bracket, but let's just say that from $0 to $10,000, you paid 5% tax. And from $10,000 to $20,000 was a different tax bracket. It doesn't go back to $1. It would just be the amount from $10,000 to $20,000 is taxed at that marginal rate. And then over 20, it could go up again. That's a fictional tax bracket I gave you. In fact, most people on the first $10,000 aren't paying any tax. But anyway, I just want to make sure I kind of break down what a marginal tax rate is if I throw out words like that. So anyway.
Yeah, of course.
So it's a good idea to plan ahead for the tax impact, especially if you're withdrawing from other accounts like RSPs or RIFs. So depending on your situation, going back to what we talked about a second ago, Lindsay, delaying CPP may also provide some other opportunities for planning on lifetime tax savings, right? So again, this is why deciding when you take your CPP isn't as simple as when you want to take it, but there's other things that you could incorporate into this decision that could potentially get you further ahead financially.
And can you continue contributing to CPP if you're working in retirement?
Yeah, you can. So if you're under 70 and still working while receiving CPP, so you could be receiving CPP, but you can also still be contributing, or you can just delay the CPP and still contribute past age 65. And so what you would be contributing to is the post-retirement benefit program. So these additional contributions increase your monthly pension for the rest of your life. So, and just so you know, if you don't opt out of contributing when you're 65 or older, you're going to automatically make those contributions. So if you don't want to make them, you have to actually opt out. So yeah, just important to note there, you can be working and receiving your CPP benefits at the same time. So there's no requirement to wait until you're done working to take CPP.
And I think this question sort of speaks to the importance of financial planning, but how does CPP integrate with other retirement income sources?
Sure. So CPP is just one piece of your retirement income puzzle, right? So it works alongside your old age security, other employer pensions if you have those, other personal savings like your RSPs or maybe TFSA if you've been saving for retirement in your tax-free savings accounts. If you're a business owner, you might have money saved up in your corporation, which could be another retirement income source, right? So CPP, again, it's just one piece of that puzzle. So the goal is to create a diversified income stream that's meeting your retirement spending needs. So it really starts, so retirement income planning starts with understanding like what are your cash flow needs? Because if you don't know how much you need to meet your lifestyle requirements, it's hard to plan your retirement income sources, right? So you need to understand what your cash flow needs are. Then from there, you can determine what retirement income sources are available to you, how they're taxed, how much after-tax income they're going to provide with you. And so once you know all that, you can use your personal retirement income sources to supplement your fixed income. So what I mean by that is you might have fixed income sources like CPP, old age security, and maybe a pension. And so maybe they're providing you with $5,000 a month after tax of income, but you need $7,000 a month to meet your retirement income needs. So that's where then you look at your other savings, like RSPs, for example, and you figure out, do you have enough there to create that extra $2,000 a month of income in your retirement, right? That's a very simplified example, Lindsay. It could get a lot more complex than that, depending on your goals and everything else you have going on. But that's the idea is, what's your cash flow? What sources are available? And how do you supplement or make up the difference?
So any final thoughts to wrap up or action items for listeners?
And I think it just comes back to what we talk about quite often, Lindsay, which is making sure that this decision is made as part of a plan. And so if you haven't retired yet, you haven't taken your CPP yet, but you're not doing any planning, like this would be the time as you're approaching retirement to start your plan, figuring out where this fits in. And you really, again, it comes back to understanding those cash flow needs, right? So you don't know how much income you need to, I guess, get to your lifestyle requirements if you don't even know where you're starting. And so maybe if we dial that back, so I go to a simplified action item here, Lindsay, it would be getting started with Service Canada if you don't have an account already, and looking at the estimates on there for what your CPP could look like.
Perfect. Well, thanks, Joe.
Thank you, Lindsay.